Hello and welcome to another episode of Macro Mondays. My name's James Brodie. I'm Head of Learning and Development here at Onyx Capital Group.
And I'm James Todd, Direct Trader here at Onyx Commodities, giving you insight from our trading floor.
Busy week last week. The economic data continues to deteriorate in the US with both ISM and employment data coming out weaker than expected. And bond yields continue to hover in the danger zone, 30-year yields up at 5%. This has to be concerning for the US Treasury Department.
The Chinese economy continues to make headlines for all the wrong reasons, as it looks as though it's stuck in deflation with latest data out. And hedge funds have increased their bearish equity bets as we see more capital flight from US equities.
Firstly, the US economic data. ISM services came out last week below 50 and way lower than estimates. Bad news to start off the week in the US. ADP employment was a 5 standard deviation miss. Initial jobless claims jumped higher, and then US payrolls came out at the end of the week. They were weak, but not as weak as the market feared. So actually yields rallied into the weekend. 139,000 jobs created. Unemployment rate remains at 4.2%, but that's only just. It came in at 4.24. And Canadian unemployment also came out far worse than expected. That's at 7% now. 1.6 million people unemployed. That's the worst since the financial crisis. The chart you can see here, this is US unemployment. You can see the unemployment rates, it's trending higher. You can also see the consumer confidence, the light green number here. This is jobs plentiful minus jobs hard to get. That's trending higher. The key point, it's trending. This unfortunately trends well, unemployment, and right now it's trending higher. And you can see the shaded areas, that's when we get recessions. So the data's not disastrous, but it's trending in the wrong direction.
Yeah, it's slow moving, as you say, but the context of unemployment, as we've said for a number of months, we're in a relatively low period of unemployment in the US, but the trend is upwards, and that's a hard ship to turn. So I would expect this to carry on in this trajectory as well. And this low unemployment figure has almost been a source of comfort in and amongst pretty terrible data for the past sort of 6-9 months or so. But if we see this continuing to carry on upwards, then that's going to be of little solace to a lot of people.
Yeah. And actually the price action was pretty interesting because all the data over the course of the week was very bad. The market was expecting a very poor payroll. Actually, it's weak, but it wasn't as bad as expected. So yields jumped, gold sold off, and equities rallied into the weekend with the S&P closing just above 6,000 level. Also, key event last week, the big fallout between Donald Trump and Elon Musk. And I mean, there's huge implications for this, both political and from the financial market perspective.
Yeah, I mean, it was a very dramatic falling out, wasn't it? With a lot being said on X and on Truth Social.
The tweets escalated as well.
It's rather schoolboyish, which, to be fair, is no surprise to anyone because you're dealing with two people who are very strong-minded and perhaps deliberately obtuse / low EQ, shall we say. But yeah, this obviously had a very dramatic impact on financial markets and almost right away as well.
There's so many implications. Firstly, from a Republican perspective, Elon Musk being a big supporter, probably him alone helped get Donald Trump to win the election.
That's what he claimed, at least, as well.
So if he pulls out from the Republican Party and threatens to set up his own party as he's threatened, then that's huge implications for Republicans. Donald Trump probably doesn't mind. He has another 3.5 years. So there's the political implications. For Tesla, of course, Tesla shares plummeted, I think, 8% on one day. And also for dollar and bonds, it's more concern about the strength of the US leadership.
Yeah, I mean, the US leadership has looked, unprofessional at times, and I think this is going to be carrying on. This is going to be a common theme. For the Republican Party, certainly, it's going to be undeniable that a man with as much financial muscle as Elon Musk will be, he will be able to galvanize more people and gain some success, whether it be in a 2028 election or perhaps even before that. So that, and you would have thought that that will naturally, cannibalize a lot of the Republican voters. There were a lot of people that voted for Trump because of his tight association with Musk going into this election. The question is, to what extent will this lead to, potentially a genuine third party, or will it just be a protest vote for some people?
Yeah, but you're absolutely right. For Donald Trump, he'll lose a lot of support because Elon Musk has such a big support base. So interesting times there. The chart here we have, this is the Citibank Economic Surprise Index, which is the white line and 2-year yields. You can see how they're highly correlated. The point here, key point, is the Citibank, the Economic Surprise Index is now coming in negative. So data's turning negative. The US, of course, ISM's ADP, jobless claims last week. So that is a further concern for the dollar going forward.
Well, and if you think about it from a political perspective, if you're having unemployment data worsening, people seeing, we've got the economic surprise data going negative, this is going to be looking bad for a lot of people that would have, perhaps been keen to vote Republican in 2028. They're going to be seeing they're no longer associated with, Elon Musk, and data is worsening, their realized prospects are worsening. So that presumably leads to the Republicans not being re-elected.
And what's Donald Trump hoping for? Well, two things. Firstly, he wants the Fed to cut. He's been very vocal last week that Powell should be cutting, but their mandate is growth and inflation. And the other thing, he needs to get his big fat bill through, which is, again, with Elon Musk standing against it now, is looking less likely. Some data out over the weekend from China. A bit of bad news here again. Deflation persists in China. CPI down 0.1% year on year. PPI down a pretty shocking 3.3% year on year. So more negative news there, more need for stimulus out of China. No resurgence yet.
No.
And the ECB cut rates last week, cut 25 basis points. You can see from the chart here just how aggressively the ECB's cut. That's the red line compared to the light blue, the Fed. But what's interesting, although the ECB's cut more aggressively, euro dollar's been trending higher. Normally it would be the other way around, but again, it shows more concern about people not wanting to hold US dollars. And on the back of that, here's a good chart from the Financial Times highlighting the relationship between US yields and the dollar. And you can see that correlation has broken. People are selling bonds and they are selling the dollar. So the debt concerns linger, and the 30-year yield is back up at about just below 5%. Again, key levels around 5.18. It breaks above that, then it's going aggressively higher, which Jamie Dimon's raised concerns about.
Absolutely. And, all of these things are really pointing to a huge loss of confidence in the US. The fact that interest rates are lower in Europe, and yet we're still seeing euro dollar strengthen. As you say, that's a sign that despite potential hot money flows leading to, you would have thought the dollar would be sort of supported against the euro on that news. That's not the case. And yields, people are not keen on, they're pricing in a lot of risk in holding US government at the moment.
So where do you send your money? Well, part of this, actually, my view, the data weakening will support the short end of the bond curve. So people will be buying bonds. We've shown the correlation with the Citibank Economic Surprise Index because the Fed will be forced to cut rates soon enough. But to me, that means the US yield curve steepens without a shadow of a doubt. But the other area is back to gold and cryptocurrency again. Absolutely.
And what I think is worth noting as well is you can have, these safe havens of gold and cryptocurrency, or cryptocurrency being referenced as a safe haven is perhaps improper, but there are other asset classes to put your money in. But even other precious metals, these we've seen a serious uptick as well, and we'll go on to analyze this properly. But I think people are scrambling for different places to put their money in. And the story with gold in particular, we've seen so much noise around the trade craft with gold, with people who were long having to sell their positions. Whilst I think a lot of money would want to go into gold, there seems to be quite a strong ceiling there. So it's not necessarily going to be getting the returns and might actually have room to the downside. So I think people are looking for alternatives at this point.
Yeah, we do have charts in a second. Huge moves last week in silver and platinum to the upside. The other one, of course, is Swiss franc. But what we're seeing now, the market's pricing the Swiss having to cut rates to try and weaken the currency. 48 basis points of cuts by the SNB over the next 12 months, with Swiss rates priced at the moment to go to negative rates again, minus 0.28%. So negative yields looming in Switzerland. With bonds here, here's the chart of the 30-year bond, and you can see how there's a support line coming through, but you can see there's a clear double top around just below 5.20, 5.2%. Jamie Dimon made it clear he thinks yields are going higher. And what we saw last week, actually, we saw the US Treasury come in and buy $10 billion of treasuries, which is their biggest ever purchase, stabilizing the market. But again, if it's the Treasury Department that's got to stabilize, then that would be another negative, in my view, for the US. A separate point on that, Japanese government, Japanese have sold the most German sovereign bonds in a decade in April. So Japan is selling both US and German bonds. Yields are going higher.
The question with the Japanese selling of foreign bonds, though, is are they selling that just so that they can afford to purchase their own bonds? And, we've been seeing that being the trend for ownership. And much like how we say it's a concern that the US are having to intervene to support their bonds, I think that's very much the story in Japan as well.
And interesting, if they do, then that's going to have currency implications to strengthen the yen, and we'll see an interesting chart dollar yen in just a second. Equities, well, lots of news last week, but equities, the S&P ground higher. You can see here it closed just above 6,000. You can see we're still some way off the peak, 6,151. There's a pretty tight trend line grinding high. So, Toddy, a question for you. We're 150 points off the highs. Where do you think the next 200 points is going to be, upside or downside?
Downside. I don't like it on the way up. And I think the continuing pattern of, especially a lot of the S&P that's not this sort of the Mag 7, or as it were, it seems to be disappointing. And Lululemon being a really interesting story, their stock has come off a huge amount, and that's based on trade disruption and that influencing their earnings. And this, I would have thought, is going to be very representative of what we're going to be seeing across a lot of US companies. And ultimately, I don't see a reason for the lion's share of the S&P to be supported. So I like it coming off here. And we'll discuss, I'm not going to be, I don't think I'm the only one who's got this bearish outlook on US equities, despite this upward trend.
I agree. And from a trading perspective, it's trending high, but the moment it turns, moving average turn lower, it breaks the trend line, there's a chance to put the trade on. As we've seen, Michael Burry, we'll see in a second, he's been buying puts aggressively. But I agree with you, the trade disruption, it's going to be easy for companies, if their earnings come out worse than expected, to blame it on that, pass the blame. So I expect we'll see more murmurings and rumblings of this trade disruption going forward. Here we are, Michael Burry's key positions at the end of Q1. He's taken a huge short. 49% of his portfolio is buying Nvidia puts. So he's looking aggressively for Nvidia to go lower. Also, he's got a big position here in Alibaba and also PDD e-commerce, which is a parent company of Temu.
Yeah, I think with Michael Burry, he, of course, for anyone that doesn't know, which I'm sure most of you do, but he was one of these people that supposedly sort of had the foresight to call the big short. And so a lot of people look at the positions he's got on, and he's been a big seller of equities over the past 6 months. He's been exiting a lot of his positions. And now the fact that, of course, he's got a put on Nvidia, it's very interesting. One thing I would say, particularly with Michael Burry, is you're at risk of reading too much into this, because whilst he did, call the big short and call the great financial crisis of 2008, I saw a tweet saying that he's successfully forecast 12 of the next 2 recessions. He seems to be an eternal bear and somewhat bearish humanity. So yeah, him exiting long positions and putting puts on is no real surprise here.
Yeah, he is famous for putting shorts on too early, so the market continues higher. But having said that, he's got a very good track record. But you're right, he's a perma bear.
He is a perma bear.
But here's the chart of Nvidia. You can see there's a clear double top at 153, and the short-term support comes in at 112. Again, it's very similar. If you look at the most recent price action, it's been a trend that's grinding higher. We know hedge funds are reduced their positions, and asset managers, hedge funds have been shorting. It's the retail that keep buying. But again, it looks like good levels to short because you know where to have a stop loss is just above 153. Better still, if you want to short it, just wait till the price action starts to trend lower. The moving average will tell you that. And again, that's why technical analysis and trend following moving averages are such a popular trading strategy and tool for traders.
And one thing I would advise to any potential retail traders out there who are looking at Nvidia, it's been retail that have been buying, as we've said, and it's perhaps been used almost as a dummy for S&P and a proxy for getting long the S&P. But what I would warn against is doing exactly that. If you're going to be buying this one, I wouldn't simply do it for trend following, because with chip manufacturing, it's going to be almost like pharmaceuticals, where trading pharmaceuticals is infamous because you can sort of be riding a wave, and your niche pharma stock that you've loved for months and years can just be nullified if either one of their patents becomes sort of irrelevant, or there's a new set of data that disproves something that they've claimed. This was always the great warning for
or the emergence of a competitor.
Exactly. Yeah. And so all of these are priced into pharmaceutical companies. I don't think they're priced in enough for chip manufacturing companies, because even what we saw with DeepSeek coming out almost overnight, that was revolutionized. And when you see that sharp downturn that you just see on that graph there, that was on the basis of new information and a new competitor coming to market. And chip manufacturing is going to be exactly the same. So if you're going to be buying Nvidia, do it for the right reasons, research around, and it's absolutely of paramount importance that you are setting your alerts and making sure that you've got every notification on chip developments worldwide going, berserk. At the sign of capital flight, you need to be on that downtrend. You can't wait for this one, because if it goes down, it could flatline.
The other thing is Nvidia have huge margins, but what you'd expect them is their suppliers like TSMC to start hiking prices as well, because if you're a supplier and your customer's making huge profits, then naturally it's an easy business strategy. Current top 10 hedge fund equity holdings. You can see here, this is dominated by Magnificent Seven. Again, they've struggled the last few months. Again, with equities not breaking new highs. Again, if we see another leg down, these could be hit. And again, this comes towards as well passive investing. We can see the SPY, more and more investment goes into there. It becomes a risk when we start to see markets turning down. For now, it's trending high, but again, keep an eye on the price action. The currencies, as we said, the US dollar remains under pressure. Euro and sterling continue to trend higher. Here's a chart of the euro dollar. You can see it's approaching 115. If that breaks, then the next target straight up to 120. But again, this is while the European Central Bank's been cutting more aggressively than the Fed. Market's trending. Can't fight the trend.
Trending, and it's going to be more expensive for any US holiday makers that are looking for a trip over to Europe this summer. But yeah, I'm not sure whether we're going to be seeing, this reversing anytime soon, with the risk associated with the US government. So I think it's trending, and I can see it trending upwards for the foreseeable future.
And a chart I like, dollar yen, we've highlighted this, and it's a good point here. We've highlighted a clear support at 140. It's multiple lows there. We've highlighted this for several weeks, even months, and that's a problem with trading, particularly for the fund managers, asset managers. who have targets to make. The market dollar yen's been going pretty much sideways now for 2 to 3 months. There's a clear level when or if 140 breaks, it's going to go aggressively lower. But again, the big question's when.
Yeah, I wonder whether if we were to see, perhaps a change of regime at the Fed in the US, whether we would see some serious price action on this. But at the moment, as things stand, it seems as though everything is data first, decision second. So with that attitude, I'm not sure you're going to be seeing interest rate changes, being all definitely not surprising at the moment. And as a result, you just see a range-bound dollar yen.
Yep, this was trending lower early last week, and then Friday's data, it suddenly popped higher with yields there. But again, the Fed, the overnight index swap, is now pricing only 45 basis points of the cuts by the Fed by year end. But I think Citibank have just come out and pushed their first cut back from July to September. But again, if we get more weaker data, that will turn around. Of course, the other side of this is Japan is raising rates. So again, if the 140 level breaks, then that's going to move aggressively to the downside. Again, basic technical analysis, you know where all the stops are for people that are long, just below 140. And you know where the entry levels are for those that want to get short, again, just below 140. You'd see a flurry of selling then, and the market would go aggressively lower. On to commodities. Gold pulled back last week as we saw, again, yields ticking up at the end of the week. But also we saw a lot of money moving into other precious metals such as silver and platinum. Here you can see gold. Clearly you can see a long-term support line coming through. But the market's really 3,450 is a big level. And then the high here, the peak of this year, 3,500. But again, we're range bound for the moment. And we've talked a lot about this. We both like it from a long side, but again, it's going sideways right now.
I think the all-time highs here being the ceiling are unlikely to be broken anytime soon. But also if we're on an upward trend and we have a ceiling at the all-time highs, something's got to give. So yeah, it will be interesting. I would love gold to start sort of outperforming its all-time high and its ceiling. But for now, it's sort of, if I were to put a buy, sell or hold recommendation, I would be on the hold side of gold.
Agree, and I'd have interest to buy as the moving average starts to move higher. Silver, though, surged 9.1% last week. Platinum moved up 10.6% last week. Platinum at one point this morning is up another 3.5%. You can see here from the chart, though, gold versus silver. It looks like, if you look at the correlations, silver has a lot of catch up to do.
I mean, I think, silver and platinum are good alternatives. That we've seen capital flight in other asset classes. Gold has a ceiling for now, so people are looking to alternative precious metals, and silver and platinum are the real winners of this.
Yep. And in the current environment, buy hard assets. Here's the actual chart of silver. You can see how it's broken through the 34.86 peak and is surging higher. But you can also see from that chart just how long this market went sideways.
Then moving on to another commodity being Brent. We seem to be, stuck in this quite wide range that we've spoken about for a while now. $69 being the ceiling on Brent. And you have a significant downward pressure. We saw more headlines in the previous week talking about OPEC rolling out their increased runs. So they're going to be running an extra 411,000 barrels per day over the next 3 months, etc. This is basically what they were doing anyway, and it's just now allowing the cheaters to sort of get away with it. There was a quite bizarre headline midweek saying Saudi is ready to be sort of putting in super runs to put basically to increase market share and put a downward pressure on Brent. So I would be somewhat surprised if we managed to break through this $69 ceiling for a while. But we do have some upward pressure coming from macro headlines as well, with a potential US-China trade deal coming in. I think overall people are slightly bullish at the moment, and you're seeing that in this small upward trend that we've had since the end of May, start of June. So we might see a bit of an upward trend and a convergence towards that $69 mark, at which point, the question of, is this going to be trending upwards? Well, Brent is such a market that is dominated by geopolitical factors that if OPEC were to really want to try and increase market share, you're going to be seeing a lot of selling at these elevated levels. So, that's just a factor to consider for any retail traders out there.
There was a headline I saw this morning as well. Demand for crude out of China is coming significantly lower last month than expected as well. And if economic data continues to fall, demand will fall again.
Deflationary price effect.
Yep.
Yeah.
More news on US house prices. Existing home sales fell 3.1% year on year. Now, that was the lowest April since 2009. Month-on-month sales fell 0.5%, expected to be positive. You can see from the chart here just how weak sales are. Interesting point though, the median house price in the US rose 1.8% year on year to $414,000. So prices are creeping higher, but demand is falling. Again, we keep saying this, when house prices typically fall more aggressively is when unemployment goes up because people are forced to sell. Then they start hitting bids, but you can see it's looking pretty weak.
Yeah, I think also, with rising unemployment, it's worth bearing in mind the time of year that we're entering into. We're coming into peak hurricane season for the American Gulf or the Gulf of Mexico. And also, wildfires in California tend to happen around this time quite a lot. And one of the factors that we've seen really influencing housing demand is the increased price of home insurance that has come from these, natural disasters. So if we were to see a particularly disastrous summer, winter going ahead, that could be very damaging for US housing demand going forward.
And you can see from the next chart, housing dynamics is already continuing to weaken in the US, where sellers outstrip buyers by approximately 500,000. Again, a complete turnaround. We had that period after COVID where there was a huge desperate buying almost, people just driving prices aggressively higher. That's turned pretty savagely. There's some pretty disastrous stories coming out of Texas and Florida, and you can see it. It seems like we've seen the peak in housing demand. Again, it's not disastrous yet. It's a bit like unemployment, but it's moving in the wrong direction.
And how do you think, therefore, if there are more sellers than buyers in the housing market, why are we seeing prices rise? Because we said that the average price was 1.8% higher. Is that just, a factor of inflation outstripping the increase in house prices, do you think? Or do you think there's something else at play?
That's a tough question.
My opinion is that it's, just not performing as high as inflation is. And it's a factor of, even if you have more sellers than buyers, that pushes prices down a bit, but that's just one strand of things affecting. But I'd be interested in any other opinions, but that's my take.
And the other problem with this, of course, is yields are back near the highs. As we said earlier, 30 yields back at 5% means mortgage yields rates are going to be nearer 7% again. Impossible time to be taking out a mortgage.
Yeah.
And if you're looking to move and you have a current mortgage taken on at low rates, then you don't want to lose that. So again, another reason why there's so few buyers out there. On to Bitcoin. Again, another one similar to gold. It's a busy week with news last week, but not much price action. Bitcoin's consolidating around between 112,000 and 101,000. What is driving Bitcoin, Todd, in your view?
To the downside over the previous week or so, I think a lot of it is Musk related. Obviously, Musk was a big proponent of crypto. And perhaps you're even seeing some of the upward trend that's been going on from the start of April through to mid-May being to some degree, correlated with Musk. And the White House was defending crypto sort of quite fervently at times. But I think moves to the upside, similarly to gold, we're close to these all-time highs, but it's not necessarily trending that dramatically upwards. Bitcoin seems to be in this range. I think it does have a ceiling at the moment, but it's being supported by capital flight from equities, from the bond market, etc. So you do see some support because money's not going into housing that much. It's not going into bonds. It's not going into equities sort of completely one way. So people are looking for places to put their money. So it might just be that I think Bitcoin and gold are somewhat supported at the lower ends of this higher range.
Yeah, non-correlated assets in the world that we're in. So the OIS pricing for the next 12 months, we mentioned 45 points by year end by the Fed, 75 over the next 12 months. ECB, just 28 basis points of cuts. That will have a terminal rate there of 1.63%, while the Fed's terminal rate is 3.57%. Again, you'd expect the dollar to outperform in that environment. People don't want the dollar. It's the euro that's going up. UK, 56 basis points of cuts over the next 12 months. Other interesting one here really is Bank of Japan hiking. Terminal rate, 65 basis points. Again, if we start to see more movement here, that should support the yen. And on to our chart of the week this week, Tesla. Lots going on. Tesla, we mentioned how it got hit by the Trump-Musk tariff risk. Tesla got hit by the Trump-Musk rift. Donald Trump's reportedly, he bought a Tesla. He's taken that away from in front of the White House. It fell 8% in one day. It bounced on Friday of news they might make up. Donald Trump's put an end to that over the weekend.
Yeah, I think, one of the things that was driving Tesla's price was its proximity to the White House. You saw the White House basically being used as a car dealership room, which was frankly embarrassing for everyone involved. But with this, very public falling out and handbag session between Musk and Trump, it looks as though Tesla's on the way down. And when you compare it, is the end product that good? Well, no, there are so many competitors. Chinese governments come out sort of all guns blazing, supporting their domestic production of electric vehicles. They're going to blow Tesla out the water, and it doesn't really look as though, as a fundamental business, Tesla has got what it takes long run to make it and to warrant, a stock price that we saw the heights of. It would require a huge amount of government intervention and protectionist policies to enhance it, and it looks as though that's got no chance of carrying on anymore, given, all Epstein-related comments, etc., that we've seen in the past week.
And looking at the chart, you can see it's now clearly in a downtrend. The target here, well, there's a clear multiple layers of bouncing at $221, but clearly it looks like it's targeting that. What could help Tesla? Well, on Thursday, they're launching the Robotaxi. If Tesla's the winner in driverless cars, then that could help them. On electric vehicles or electric battery, being the main producer of that could help them. But right now, I agree, it's trending down and it's a volatile stock to own.
Yeah.
Which brings us on to this week's data. Quite a busy week. Tuesday, we have UK employment data and Australian consumer confidence. On Wednesday, we have US CPI, all eyes on that. Inflation's a big focus at the moment. Will the tariffs raise inflation? Also, mortgage applications is becoming increasingly important. Thursday, we have US PPI, jobless claims, and as I just mentioned, the Tesla Robotaxi launch. And on Friday, University of Michigan consumer sentiment and inflation expectations. So fairly busy week. There's going to be lots of political fallout, I think, going on. Lots of geopolitical turmoil, lots of bond headlines.
Yeah, absolutely. I mean, keep your eyes peeled. It's going to be an interesting one. And I'm sure going into next week, we're going to be having, a lot of the same discussions, though, because I think the headline from this week is the trends are trending. Definitely keep your eyes peeled, and we'll be covering it all next week.
And we will be joined by Will next week. So there'll be three of us on the show going forward. There'll be more charts, more trading ideas. And as well, keep your eye out on LinkedIn. We do daily updates on our Onyx Institute page. Hopefully we'll see you next week. Have a great week. Thank you.
Thank you.